All right, good afternoon, everybody. Event Trader here, about to be joined by Brett Manning. Brett, you there with us?
Yo, how you doing?
I'm doing good. How's your day treating you so far?
Relaxing.
Yeah, so I guess before we break into anything here, why don't you give us some market thoughts on what action we're seeing here at the moment?
We're seeing relatively narrow consolidative action in front of Jackson Hole, and it's what I expect to see for probably the rest of the week, except I do believe that we're going to pop above recent range levels into the weekend. I think that we'll see above 29.50. At least that's my base case expectation, and it's what I would like to see. What I would like to see. And I generally think this way. Generally speaking, I don't try to say, here's what's going to happen. I try to say, here is the thing that would mean that I have an obvious opportunity, and then I see whether or not I see that. And if I don't see that, then I don't consider it to be that there's a definite opportunity unless something dramatically changes, and then I reassess and I start to envision different other possible opportunities. And the most basic and obvious opportunity I see right now is a move higher above 29.50, followed by into early next week a relatively clear and obvious healing in short-term sentiment indicators, and then some kind of technical signal or tape signal that we're running into some important resistance in that area, setting up a short to move down through last week's lows. That's the trade that I'd like to see, and I'm prepared for that, and I'm kind of watching what I see right now and seeing if I see anything that doesn't that shows me something that obviously doesn't fit at all with that picture, and I haven't really seen anything. So I feel like that's a reasonable expectation.
So, I mean, we're just going off the E-mini chart on this for the S&P. That would more or less be a false breakout above the 50-day moving average. Is that kind of how you'd view it?
Yeah, I mean, we're above that range high, whatever. I mean,
Sure.
you've got established resistance levels that have been in place. The market's knocked up against them a couple times. So moving through them shifts the balance of positioning as people who were, using that as their line in the sand while holding short start to give up, maybe get a little bit of a squeeze. People who were waiting to see if we could make it through that, then come in and trigger in breakout orders on the long side. And then, when the dust settles after that kind of shift of exposure on each side of the market, when the dust settles, we can track to see how the tape feels after that, and see if that's going to be something that maybe reverses right back into the range later that day or a day or two later, and then that higher level. And it's something I really like to use as a check against when you form a level and you go through that level and then you go back down below it. That becomes a relatively more important line in the sand to me, because you've already run through kind of doing what I call an inventory check. You've inventory checked above that previously established level to see just how much strength and life would happen if you get that kind of breakout. And if it turns out that there's not a lot going on, you've sort of got a disproof point, and it makes it a little bit more difficult for people to really start to get engaged with that side of the market, with strong hands. So it's more of it represents or demonstrates the futility of that direction a little bit more, and I think that impacts the psychology. And if in the same process we have shifted exposure, so we've brought in weak-handed longs that are then potential sellers, and we've chased out weak-handed shorts that are also then potential sellers as the market weakens, we've created a prepotency back to the downside. If that's also matched by sentiment data that's healed, that reinforces a deeper level of that vulnerability, that it becomes a kind of ideal short side entry with your stop then above that failed breakout tail. So that I would like to see all that come together. I have no idea if it's going to, but it's a scenario I can reasonably imagine, especially if Jackson Hole gives us some of what I feel like the id of the market is really chasing after right now.
Yeah, I guess, I totally agree with your theory and your thoughts here, but the one thing that has me questioning is, with next week being a holiday week, is there enough people on the desks to create that selling?
I think so. I think because the
Think so.
volatility we've seen lately, yeah, I do. I think
Okay. I
I've seen
mean, we
plenty of
we
really
got it during
volatile
Christmas
August.
Eve, obviously, so I think that puts.
Hey, August 2015, August 2008, August 2011. We've seen plenty of really volatile, high volume Augusts. When
Yeah.
stuff starts to happen, people are there, especially if, we've had a lot of contentious sentiment and we've started to see some volatility into that period. Usually August is thin, but when it turns out to be really robust, at the end of the month is when you have some kind of significant technical event early in the month, and it gets people back from vacation in a heartbeat, because they're looking at, how's my fall going to really look? How am I looking into year end? Well, if I blow everything in August, then, it's going to be a rough rest of the year. So I think you can chase people back onto the desk when you start to puncture some levels and you get that VIX up. And that's what we had earlier this month. So I think that, especially with monetary policy being such a contentious issue and Jackson Hole having this interesting special place historically, when there's stuff going on, when people are uncertain about the direction of monetary policy, and we feel like we're at one of those kind of moments where, who knows? We just had, essentially, we've seen a liquidity trap conditions in both Japan and the EU. It basically says monetary policy no longer works there at all. And here we are in the United States, and is that going to be us next down the road?
Yeah,
and
going down that rabbit hole next, right?
What's the Fed going to do to make sure that doesn't happen? And I think that that's on everybody's mind. So I think that that puts a special spotlight on this particular conference, particularly given that the stated theme is pretty much directly in line with that, right? It's like new challenges for monetary policymakers or something.
Yeah, that's the theme of the entire conference.
And that's basically like, well, look what's happening in the EU and Japan. Is there any way to avoid that? That might as well be the title. Is there any way that the U.S. can avoid that down the road? So how they handle situations like this, do they really say, we're going to run inflation at 3.5% if we can get it there? Let's go to full QE and reduce interest rates into negative territory right now. Who knows? Or do they do the opposite? Do they say, you know what, when you get interest rates too low, it causes people who are, for instance, in retirement to spend less rather than invest more? They don't move this is an interesting theory, I think. They don't move their money from bond market into the stock market when interest rates are really low. They just spend less. And if 80% of the wealth in our society is owned by people who are in their 60s, 70s, and 80s right now, then perhaps interest rates at zero isn't really going to force them to start to bet on Apple stock. They may just stop spending money. And it may be that that's some of what we're seeing. And so, do they start to come from it from that perspective that there may be a danger, or maybe you cause a greater risk aversion in the banking system? Who knows? But there's a lot of different directions the grand theory for monetary policy can go from here. We may even see some presentations entertaining, modern monetary theory or some derivative thereof, or at least saying we need to explore something because, what we're watching right now in the EU just ain't working.
Yeah.
And what are we going to do?
Yeah, it's funny because I don't think I've ever seen such divergence in the Fed speak as well, too, where you could have Bullard come out and say one thing and then Esther George come out and say the other, and obviously both voters, but they diverge so much. Rosengren, whoever you want to look at.
He had a really interesting set of statements. I'm basically making the point. To me, here's how I read him. He was essentially saying we don't want people taking on more debt right now because all we're doing is propping them up with further default.
Yeah.
And that's a really interesting. He's saying recession is coming, and if we float a bunch of easy money out there right now, then the
people are going to get caught.
The comeback to earth is going to be so much worse if we just create a much bigger bubble of set to default.
Yeah.
Which is interesting to hear a central banker at this point in the cycle kind of taking that position. Do we really want to prop people up on thin air right now?
Well, they've certainly been pointing a lot towards corporate debt being an issue of concern for some time, right? I mean, that would be along those lines.
And what if you start with that? I think this is what he's saying, personally. I think you're saying, okay, let's get corporate debt into a potentially vulnerable situation, and then let's go ahead and incentivize a ton of new consumer debt. Let's get everybody to get $200,000 of credit card debt and then have them lose their jobs. So the dominoes are set up. Right from consumer defaults through corporate defaults through bank defaults. I think that when you get to this point, you can help companies do better if everybody starts spending crazy on credit cards. But then if suddenly those become vulnerable debts too, you've just set up a chain of dominoes. And I think that's probably to some extent what he's saying. We don't want to incentivize greater risk taking at the household level now that we have these other dominoes set up.
Right. I suppose at the same time, a 25 basis point difference I don't know how much that makes for people spending on credit cards. Certainly for mortgages and everything, I would think that that would be the case. But it's going to be an interesting symposium, that's for sure. Now, I haven't seen a schedule for it yet. I know Powell speaks Friday around 10 a.m. Eastern time. You haven't seen a list of other speakers yet, have you?
No, I have not, and I'm sure that it will be framed as a very dry and academic list of topics. But I think that it will be something that has greater implications. I think that it's more applied now than we've seen in a long time.
Yeah.
Even the most dry-seeming academic topics are going to have to do with what.
This has probably been the most important one.
Well, but even the most academic panel discussion is going to have some theoretical, applied some kind of real application to what we may be facing a few months from now. So how do you handle a situation where it looks like monetary policy tools don't have a lot of room to run in terms of their impact? What do? And that's going to be a lot of what the conversations are about. So I think that a lot of Jackson Hole in the past is you got the Fed chair indicating whether or not he's going to say something that has to do with the next 3 or 4 meetings. And in this case, I'm assuming there will be something like that. But then the rest of it is just then, okay, now let's kind of, recede into some kind of tweed-jacketed panel conversation about extremely abstract topics that only economists care about. But this time I think that it's going to be much more
Someone's going to look through a read-through. You can't discuss price targeting with some sort of read-through on this being a dovish statement.
Right. If the economy starts to pick back up, when's the next hike? That view will be determined by what they talk about this weekend. It could be way after we get well past 2%. Let's just say in theory they cut and they cut again in October, and then we do start. Let's say we get a trade deal. And you do start to see things really pick back up. Let's just say not that this is necessarily going to happen, but just in theory, let's say that this turns out to be some kind of next level mid-cycle slowdown. We start to see another acceleration into next year, and suddenly inflation is running at 2.4%, 2.6%. Based on what they talk about now, that's how analysts are going to understand when the Fed's going to start to tighten again, because they may start to think in terms about we need to give ourselves more room. We need to see 3% plus inflation, and to have that sit around for a year and a half before we start hiking, because that's how we avoid this situation. I think that there are people at the Fed that feel that way, particularly just like you said, when you're talking about price balancing. So I think that type of conversation is going to have very direct relevance for people who are planning out portfolio management.
Yeah, no, I completely agree. So let's break into some of the sentiment then that we're seeing out there, Brett, and talk about some of the positioning, and then we'll take a walk down the road because Jackson Hole's obviously going to be large, but we're going to have a few things set us up before Jackson Hole with the Fed minutes, the ECB minutes, and the PMI numbers too, the preliminary look at it. So I think that's going to kind of help set up sentiment going into that Jackson Hole meeting. I think we got a pretty fair idea of where we are. Certainly it feels like the last 2 weeks has been relatively steady on the sentiment front. A little bit of a pullback from some extremes is what I was seeing in a lot of the readings going on there. Yeah. On both sides, which was kind of interesting. I felt that we were seeing a little bit of a pullback from a couple of extreme pessimism and extreme optimism. It felt like, but was there any
extreme optimism?
The extreme optimism was looking at the risk appetite seemed to pull back a little bit. The bull ratio had popped up, right?
Yeah, that's pessimism.
Yeah. Okay. So
bull ratio was in extreme pessimism territory.
Right.
In one of its sharpest moves in years, a couple weeks ago. Basically, it dove to where you would want to be bullish as a contrarian, but it shows that there is a tremendous amount of bearishness. The bears went way up in 1 week. It was a very strange, anomalous 1 week move. About a week and a half ago on Thursday of the week before last, there was a gigantic move higher in the number of bears and a gigantic move lower in the number of bulls. And last week's data point then followed that up by being about the same. It didn't extend it further. In fact, it checked back against it a tiny amount, but basically it's sitting in what would be considered to be extreme pessimism territory in that survey.
Right. Well, one of the surveys that was coming out that I was seeing flip back between extreme optimism to extreme pessimism was that 10-day up volume ratio. You ever follow that?
I don't. So tell me about that one.
So, well, last week it sunk into oversold territory. Last time that had happened was in January. It was followed up by a number of positive days to trigger what was called a breath trust or thrust. Was this week breath trust? Yeah. So that flipped back,
which has been a great signal. That's happened twice in the last 8.5 months, and both times it's led to huge rallies.
Both times it led to huge rallies, and that's one of the areas where I was looking at a flip from extreme pessimism to optimism, where
money
the S&P on Friday and Monday, 90% of the stocks rose last week. So that was the first time since 1990 that's happened. It's only happened twice before. December in 2014 and August of 2015. August of 2015, of course, would have been a couple of weeks right after the yuan crisis, and I felt that was kind of interesting, the parallels that we're seeing here. Obviously, the 2015 yuan crisis wasn't really built around a trade war per se, but it rattled the markets similar to what we saw earlier in this week. So that was one of the things that was really catching my eye in terms of a move from extreme pessimism into a little bit more of an optimistic tone, and that's why I was curious if you followed that a lot.
Yeah, no, I'm looking at it now. That's an interesting point to make. So what we have is a situation where now I would argue that this does happen, obviously not quite to the quantitative extreme, and there is some data mining in this kind of process.
Right.
But the general dynamic of seeing big 90% up day followed by 90% down day followed by 90% up day, that does tend to happen in the context of bear markets. Because what you end up with is a higher level of across the market correlation, right? When generally speaking, bear markets are defined by an increase in correlation. All stocks go down or all stocks go up. And a really archetypal bull market trend is defined as it goes higher by a gradually downward trending correlation between stocks. So it becomes the feeling of more of a stock picker's market. Some stocks are doing well on one day and other stocks are down. The next day it reverses. The volatility is lower, but people are willing to make specific investment decisions about a particular company because of where they see the company going in the future. But when you start to get into a bear market-y feeling situation, it tends to be an all or nothing for everybody, because if it's a bear market, it doesn't matter what your company does versus another company, probably the equities are all going lower. So you end up with this higher level of correlation. So one thing the breadth thrust idea, as the Marty Zweig idea, has worked really well in January and again in June. This wasn't quite a full breadth thrust, but it was a particularly powerful up volume thrust. And I would say that there is the danger that you could start to see 90% days back and forth, and that would dissolve the meaning of that signal to some extent, because it would just suggest, and here's another point to reinforce that a little bit. What's the one indicator that we see at an extreme, and it's been at an extreme for the last couple of weeks every single day? That's the SPY liquidity premium, right?
Which moved away from the excessive pessimism.
But it's still way at an extreme. It's still well above where it historically normally is. Even if you look at it right now, it's still, it's at 0.41. Typical range is around 0. It goes from the negative to positive. Under 0.25 to negative 0.25 is a typical band of historical levels for that data point. It's well above that right now, which means the ratio of volume happening in the SPY ETF to volume happening in the individual 500 stocks of the S&P 500 is tilted unusually toward people just trading the SPY ETF. And that,
right,
as we talked about,
but that would be pessimism then, right? So that's would
pessimism,
be a buy
exactly.
signal.
Well, from the standpoint that people are pessimistic, and yes, right. So that means that this is not a period. Well, let's just say this is not a period where people feel complacent. However, it may also explain the 90% up and down days, because if everybody's just trading the indices, then the SPY feeds that volume through to its components. So you're not seeing different orders in different directions among the different stocks. If the orders are all going into the SPY, then the SPY is translating them into its 500 components. So in effect, if you buy 100 shares of SPY, you're buying some small amount of all 500 stocks. And if everybody's just trading the SPY, then you're going to see 90% up day, 90% down day. And it might not mean quite the same thing it meant
I hear what
in
you're saying.
January.
So you think it's been kind of washed out because of the ETFs and the SPYs. It's not as much people are
It may
buying
be that
as many names. They're just
It
buying.
may be that there's an indexing trade. And I would suggest one of the natures of that indexing trade might simply be that people who have long portfolios who don't want to bail out of their long portfolios are either putting on large hedges or taking them back off as their confidence increases or decreases.
Okay. So with the SPY liquidity.
Hold on. Can you hold on 1 second,
Sure.
Gav? Can you hold on 1 second?
Yeah.
All right. Can you hear me?
Yeah, I can hear you.
Okay, yeah. I just shift around a piece of technology, but all good now. So
Okay,
go ahead.
no problem. So from what I was seeing in the up volume piece, if we're in a sustained uptrend and the indicator becomes oversold like it was, then it suggests that an upside reversal may be forthcoming. So are you telling me that you disagree with that?
So what I'm looking to see specifically is some of the indicators, just like the SPY liquidity premium, to have healed and gone back into normal ranges by Tuesday or Wednesday of next week. So that's my setup is actually to see some of these.
That would be your setup for the short side now.
That's correct. So I'm actually looking for something where these things that look like sentiment data buy signals turn into sell signals faster than they should on a relatively unimpressive rally. And that's been something I've seen a number of times in the past that has led to particularly good short side signals in a situation where you may have some longer term issues. So you start to get everything lined up. It's tough. People are looking at some of the longer term negatives right now. For instance, the impotence of monetary policy as growth slows and the inability to get some kind of a fundamental catalyst going like a trade deal. Like you look at that situation and maybe you want to pound the bid right now and you want to get short this market, but the time isn't there yet because you've got some of these other signals we're just talking about, and you're only going to get yourself squeezed out up through 29.50. So my setup is to wait for people who are too early to that trade to get kicked out of it, and then to pick it up from them. And that's an idea that's worked for me in the past. But you have to be honest with yourself. If the market moves higher, and then you really don't see the type of tape you should see if this thing is failing, from above that level, you start to see more constructive grinding action like we saw in mid-June, like we saw in January and February, where you're coming out of a level, you're moving higher, and it just isn't the type of tape that's weaker than it should be on catalysts, that's showing you that big lead blanket offer. You're not seeing those sorts of effects. Then you have to be honest with yourself and flip your bias. But I believe that would be the most interesting and lucrative opportunity that this market could give me right now. And so I want to, in effect, watch for the bullish sentiment signals to fail as we start to see some of these indicators like SPY liquidity premium move back into a normal range after maybe, Powell comes out and outlines what sounds an awful lot more like an easing cycle rather than a one-off insurance cut. Like he did at the last meeting. I feel like the futures market's certainly looking for that. If he really makes good on that, and then we move on to a very academic feeling conference without a lot of other big waves, market, gaps higher next week, and we start to move around above 29.50 and then maybe start to see some bearish tape dynamics come into play, then that would be the setup.
Okay, with the options activity, from that, we're still seeing, I was watching the robocall ratio. That's basically in the midpoint of the range here. So you pulling anything away from the robo at this point? I know it's moved away from that excessive pessimism extreme. It hasn't really gotten to the excessive optimism. Would you like to see that jump into excessive optimism when we come back and talk about this on next Tuesday?
I would like to, yeah.
In terms of setting up for your short trade.
I'm not guessing it's going to happen in that indicator, but that would be really, tremendous from the short side if we saw Robo really
as part of your break above the 2950 area, right?
Yeah, I mean that would be spectacular. I think some really shorter term, faster indicators will be easier to see that. Something like SPY liquidity premium makes is a reasonable example, or we really see something like inverse ETF volume fall through the floor. It's already fallen back quite a bit, but really dramatically. It's going to be tough. I'll be looking at the VIX term structure and just actually watching the contracts trade. And trying to get a sense, are we seeing, this risk really repriced to a more typical balance between contracts where you start to see, obviously, the future is more uncertain. 3 months out in the future is more uncertain than next week. That's typically the way that it's structured, and when you get into some volatility, it flips. So, it's already started to come back. If I see that a little bit more steeply contango-driven. And, I think that at that point, as long as there's nothing that's still screaming at me as people are really pessimistic, we can see the Robo go the other way. That might eliminate it.
Yeah.
If we see Robo really move toward everybody's really just buying puts only, right into this meeting, then I might be a little bit hesitant to move on this. But I may still take a shot if the technicals are right. Yeah, obviously. Right.
Lobo's basically been flat.
Right. Now, what I would love to see is something that shows me that there aren't those problems there, and then maybe we get into next week. We've got some breadth issues on a rally, but the indexes rally. You're holding up a little bit, but it doesn't look great. And then we start to see something like just a basic put call start to show me, like a 65 print. Just seeing some really, a lot of calls, not very many puts, and yeah, I mean, and it's really going to come down to just kind of getting a sense of how the tape feels. I think that probably at the end of the day, if the patterns work to me, that's usually the most important point.
And you were talking about the VIX term structure that moved out from the excessive optimism. You'd like to see that move back into the excessive optimism, I would think.
Well, it moved out of the excessive pessimism, right? So it was at excessive optimism before the last top, and then it moved into this, this crazy crazy market,
right.
After Trump came out and threatened the extra tariffs and everything. We moved up to backwardation, which anything above 1 on the VIX term structure indicator, where it's looking at the 1 month out versus the 3 month out in terms of pricing of the VIX. So if the 1 month out is higher priced, let's say the 1 month out VIX is at 20, the 3 month out VIX is at 17, then the 1 month to the 3 month ratio is going to be a number above 1, right, rather than a fraction. If more commonly you see the 1 month out is lower than the 3 month out, just basically for a very simple commonsensical reason that the further out in the future is more uncertain than closer in the future, generally speaking. And the VIX just stays in that kind of contango under normal conditions almost all the time. But when you have a market panic, it flips because people think there's something extraordinary going on right now, but 3 months from now will probably be a more normal environment. And that's the assumption that then works through in the form of a backwardation, where the price of the VIX 1 month out is higher than the price of the VIX 3 months out. So you get the positive number. You get above 1, you get a backwardation. And that's what we had in the crash that we saw after the devaluation of the yuan. We've worked back from that, back into contango. So we're back in mild contango when you look at the 1 to 3 month on the VIX futures term structure. I would like to see that deeper contango, as a sign that people are really not pricing a tremendous amount of uncertainty right now. So you see the 1 month lower. I'd like to see the spot VIX lower, but 3 month, sloped up from there, so that I just get a sense. It's just about that curve. That forward curve on the VIX futures is a statement about how scared people are about what's just about to happen. And when you see a nice contango curve, you know that there's a little bit of complacency baked in. So in this environment, if we return to that kind of sense of a little bit of complacency, and then we start to show some behavior just in the tape, just in the patterns that looks to me like there's a problem there, then that vulnerability starts to creep back in, and it looks like something I can take advantage of.
All right, so we talked a little bit about that sentiment data. It's gone back to a middling sense. We'll be watching closely to see what if it tilts either way following the Fed. Kansas City, Jackson Hole, of course. And again, we've got those preliminary PMIs and Fed minutes as well beforehand. Now, the flows, that continues to point in towards a more bearish setup right now, right?
I mean, you know,
In terms of, I mean, we continue to see money pouring into bonds. Equities outside of the U.S. is certainly not seeing any interest from people. And what is it? Just taking a quick look at the flows here. Equities had a modest outflow of 4.7 billion last week, according to Bank of America. Survey, the flow show that they have there, and then mutual funds saw 6.8 billion of outflows there as well. So it's starting to see a few people moving out of bonds, but certainly not into equities. And I didn't really notice any uptick in the cash position. Did you?
No, but I think that what we have is there is an indicator that would be conceivably bullish for the stock market if it weren't just continuing to trend. So it's been the case. It continues to be the case. And, you know, what's to say that next week this is going to stop happening? Money is going out of equities and into bonds. And that may well be the case.
Which had the fourth biggest week ever of inflows at 16 billion last week.
Yeah, and that seems like a quote from every one of our shows in the last 3 months.
Yeah.
You know, I mean, like it's the same. It just keeps happening. And it's you know, and interest rates are just going more and more negative abroad, and our curve, we're getting 2s, 10s inverted now, and I mean it's the ice age back again. You know, the things had thawed out, and now the ice age is back again. What we saw for most of the first few years of this cycle, and then again in late 2015 and most of 2016, it's the same kind of process. And you know, it may be that this is with us for the next 2 years. It is. There's a theoretical way to look at it as a bullish signal for the market, but only if it represents, you know, locked up energy that's going to be released back into the equities market.
Right.
And it just doesn't ever seem to happen.
You need the sentiment to break that fever, it feels like, before the flows can follow it.
Yeah, I mean, you need to shift this pattern of behavior, and I don't see any reason necessarily why that's going to happen.
Yeah,
you know.
like, I mean, the obvious question is what breaks this fever, and I just can't think of anything. I mean, perhaps a settling of the trade war, but I don't know if that's that could help. But you still got Brexit, you still got Italy on the table, and a number of other issues, but. At some point, monetary policy is kind of going to have to break down, and I feel like there's going to be a study of the last 10 years of central banks on where they went wrong, and it feels like it's going to be an exact opposite of the studies of the Great Depression, doesn't it?
Yeah. I mean, it seems like there's right. Yeah, sure. It seems like there's something that we don't understand here. And you know, there's two ways to look at it. One is that, if we weren't doing all this, imagine how bad it would be then. And the other is there something we're not understanding about how we're just contributing to a problem, and it's we don't know which. And I'm sure that will be a fervent topic of discussion this weekend.
Yeah, exactly. So with the flow data that we're looking at, Brett, you know, we've been talking for a while about the lack of money flowing into equities. So with your flip it over to a short thesis on this, and now I know a few things need to play out in order for this to really roll out, but the last couple of weeks, the general theme that we've talked about is a bubbling of a possible blow-off top here with the amount of money that's on the sidelines. What's changed for you in the most part? Do you just kind of feel like perhaps that equities, I don't want to call it a bubble, but inflated a little bit, that we could see that drop given the lack of money that's flowed in, that it's a little soft and prime for a steeper drop off than people are expecting, just because of the lack of liquidity that could be out there in terms of money that's in the stock market?
I think that there's two things that's changed for me, and it may be that everything I'm about to say in the next couple minutes, I completely disagree with next week. It's possible, but what I will say right now is that we had a notable failed breakout on long-term charts in the indices, first off, right? So we were talking about that in the run-up to the last breakout to new all-time highs in the S&P, NASDAQ, et cetera. We broke out decisively sat there, went sideways for 2 weeks, and then broke back down decisively. So there's a way to look at this as a larger topping pattern where that is the failed breakout that we saw in 2000, we saw in late 2007 in October. We've seen this pattern at a number of tops where you have this kind of situation warming up. You break out, you fail, you crack back down, and then you start a process of deterioration. We'll see in terms of the evolution of sentiment data. That's part of it. The other part of it is we've talked about this topic quite a bit. The trade war is something that's politically solvable as a problem. You can come out, you can backtrack on this, you can say, you know what, in a stunning revelation, the White House has reversed its course on tariffs. And they now believe that the most important thing to do is a multilateral agreement for trade deals that exclude China unless China is willing to play towards certain rules. And they might get everybody else in the world to come on board and join some kind of big trade pact. And now the leverage is on China to have to make its changes without the tariffs being there. They can continue trading with us in the other way, but they don't get advantages to this new club. That's just another theoretical way to play the same situation that would have less economic damage. Let's say that were to happen. Everybody backtracks on that whole thing. So there's been this possibility hanging out there that some kind of change like that could happen. And then instantly you start to see this big jump in business investment and business spending because now they feel confident that there is this different path that everything is on and that it's a path they can trust. Now, I think there's a couple problems with that now. That used to be an option. That used to be something that could happen, and people had to maintain exposure to the market in case it happened, and I'm talking about like a year ago or 6 months ago. But now I think that we've gotten to the point where two things have happened. One, I think we've gotten to the point where the lack of business investment that we've seen so far has caused collateral consequences that then wouldn't be repaired under such a situation. We've damaged supply chains, we've damaged all sorts of things, and we've damaged foreign economies in ways that aren't going to be immediately reparable by a political solution. Also, I think in addition to that, we've created such a context of shifts and information changes and messaging problems that I think that if that statement that I just suggested were to be announced by the White House tomorrow, I think that it wouldn't necessarily bring an influx of business investment because people would believe that could change a week later. So they have lost a kind of sense of confidence in terms of having being able to engender faith in a particular path that they would be committed to, that would seem like something that is in the best interest of a lot of businesses that are really tethered to the international economy. And I think that that's no longer, so I think it's become, in other words, I think it's become less politically resolvable with a quick shift in tack. And so I think because of that, we're more likely to see some kind of deleveraging of the economy now. It may not happen. I may be completely wrong, but that would be the next step, is that all of the debt that we have piled up, it becomes increasingly vulnerable as we start to get people pulling back on risk acceptance. So something that looks like a reasonable amount of debt now wouldn't look like a reasonable amount of debt if we start to get counterparties pulling back, we start to get credit lines being a little bit more risk averse. Then suddenly things that weren't a problem become a problem, and that starts the type of shift that, generally speaking, leads to more important contractions or more important bear market trends. I think we're more vulnerable to that now than we've been in a long time, and I'm not sure that a shift in monetary policy is going to heal that. So, again, a week from now I may say, what was that guy talking about? All that stuff is ridiculous. I'm long the market. That's possible, but I'm entertaining thoughts like that now, and if I see a setup that starts to make sense in that framework for viewing the market, then I'll be more than willing to take advantage of it.
Yeah, it's definitely something we want to look out for. And I was talking earlier, Brett, I don't know your feelings on this, but October is certainly setting up as an interesting month given the fact that we're going to have Q3 earnings where I think a lot of that theory that you're just talking about there could start playing out a little bit more if we're seeing just that warning from people that, okay, that second half of 2019 recovery, not only is that not happening, but things are getting worse out there, and just builds off and becomes a self-fulfilling prophecy, and then start talking, it bleeds into the credit markets, and that's when it could really get ugly if we see that start playing out. Just while we're talking here, Brett, just watching the markets, we're near the session lows here. The president's on TV, just basically reiterating comments that he made before about the Fed needing to be a little bit more proactive and cut rates as much as 1%, and also discussing the potential for a for a tax cut, for a payroll
Hmm.
tax cut, I think it was, that would help consumer spending. So, just some talks about some fiscal assistance coming on. We saw Germany as well too. I don't think I've talked to you about that. You have any thoughts about the German fiscal stimulus that we heard being bandied around last week?
Yeah, I mean, I think
Long
it's
overdue.
well, it's long overdue, but it's also like, I mean, how quickly are we going to be back uh, in Alexit conversations? There's this will highlight once again this issue that there is a monetary channel across the EU and not a fiscal channel across the EU. And so, with one hand, Germany will be, providing itself fiscal stimulus, and with the other hand, it will be telling Italy it needs to be austere.
Yeah.
And we're just going to be like, how quickly are we going to be back in that conversation about the euro being suddenly vulnerable to dissolution of the eurozone? Like, it just seems like that this if we are in a cyclical shift or anywhere in the neighborhood of one, boy, that conversation is going to be quick.
Yeah, which is
Yeah, it's
one
on
of the
top of
reasons
us.
why you're short that euro, I suppose.
Yeah, I just see that. I just see a big giant, what I call an escalator pattern, which is something I've written about a number of times. Just if you look at the monthly chart for the euro right now, it's just, I mean, that's a type specimen escalator pattern. It leads to an acceleration to the downside. I may be something I have to take a couple shots with, because we may see a squeeze out of something. Maybe perhaps Powell is even more dramatically dovish, and we squeeze this thing up and hit my stop, but it's only a quarter-size position. And I'm just I'm getting a toe in the water right now.
Yeah, and it's not a bad toe to have. I mean, we got the ECB minutes on Thursday. I think that's going to even strike a more
Yeah, Fed
dovish
minutes on
tone
Wednesday
than
too.
Powell can.
Yeah.
Yeah, exactly. Fed minutes there. And then just going back to that October theme that I was just getting into with the Q3, we're also going to have the potential for Brexit and Italian elections. And if five-star movement gets in there, be curious to see if the Eurosceptics are able to stave off some of that, or if we can see that continue to build. But
I wonder. Oh, I got a question for you. You know how the EU approaches their negotiations with the UK?
mhm,
That
yeah,
strategy and the bearing that they have at the table, probably it would be
goes out
so
the
interesting to
table.
see how. Well, it would be so interesting to see how it evolves, right? If suddenly they're also kind of implicitly trying to send a sort of signal to Italy, like.
If they got even tougher with it to make it
Is
so
that what they
unbearable,
would do? I could see it.
could they though?
Like,
But
do you make an example of the UK to make sure it's not, Spain, Portugal, Italy, Greece? Like, it doesn't just turn into that, the arms and legs all pulling out aside of the torso suddenly.
well,
Um,
I think it's tough for them to make it extremely prohibitive for people to leave at
but
this
I think they
point.
want to,
Just
though, right?
they definitely want to. They don't want you just to be able to jump out and stuff. But it wouldn't surprise me too if they're kind of getting to the point where they want to divvy up the euro into the northern side and southern side and just have the stronger, more fiscally responsible northern side economies in the euro and
And then watch,
just
yeah,
let
the
the southern
southern.
side just kind of eat themselves in a beggar thy
Well, I
neighbor
mean,
type.
yeah, the currency devaluation would be just gigantic, and then Italian growth would pick up.
I mean
I think.
that would be another
I think that's what
space.
happened.
I'd be curious to see what that supply chain looks like too. I know most of the labor's gone over to Asia just because of how cheap it is, but I'm sure there's got to be a lot of cross-border issues that
Yeah.
would go on with that too. So it's going to be
My take
interesting
is
to
the
watch that
same.
play
My
out.
my take is the same as it was last time around. I'll just say this for the record: either come together or get apart.
Yeah,
And they've been halfway together forever. And
and
it's either the United States or Europe, or it's a bunch of separate countries. You cannot have a monetary channel without a fiscal channel. It will
right.
always break apart.
And whatever you might think of him, at least that's the one thing that Boris Johnson is bringing to the table this time around. And I think that's one of the reasons why people kind of want him in there. It's either get out of the EU or stay in.
Yeah, right. And they were stupid to get out, probably, but now they are where they are, and I don't know what you do about it.
Well, I mean, you're short in the euro, so I mean, I can't imagine that that means you think that they'd be smarter for staying in.
Well, I mean, it's the past has consequences for the future, but yeah, I mean there's obviously a problem, and I would look at that chart and I just see where it's headed, to me, it looks clear. I mean, again, if we see the pattern evolve in a way that starts to bend it into something constructive, I'll obviously abandon the position. But right now, to me, it appears as though, especially when you look at speculative positioning, it's really not very extreme at all on the short side in the euro anymore. It used to be. For a lot of the grind that we've seen, there was a ton of shorts in the euro. They're not really there anymore. It's net short, but it's not extreme at all. And we're looking at a pattern right now, to me, on the weekly chart and the monthly chart that just looks like this is a grinding thing that gradually turns into a waterfall decline. So,
yeah.
That's what and Trump's going to love that. Can you imagine if that's right? Do we start to get the intervention threats? I mean, the dollar's going to go through the roof if that happens.
Yeah. I mean, it's going to be a curious set of events to watch play out
Does he
here.
Fire Powell? Like, what's the next step if the dollar starts to go in a parabolic move higher?
Well, I mean, he's already flipping out, right, with the looking for a 1 basis point cut at this point. So,
yeah.
He's just talking about taking on China. Just watch this play out. We're sitting right around the lows, holding up at the moment, but it's definitely looking like a heavy tape out there. That's for sure.
It is, but it's inside of that context. If you pan back a little bit of a consolidation of yesterday's gains in the very upper, or the last 2 or 3 days gains in the very upper part of that rally. So we're, I see if we broke meaningfully under 2,900, we get down to under 2880. I would start to see it as something that starts to shift that picture a bit.
Level would start shaping into play.
But I mean, as long as you're above 2885 to 2890, as long as you're really above 2890, I think that you're just in what could be seen as a constructive lateral correction of a large rally off of the lows from last week. And, that is something that would fit perfectly with bouncing back and forth inside of a lateral consolidation up around the highs of the 2-week range, leading to a breakout above next 29.25 and then 29.50, which is where I think you start to run into trouble.
Okay, well, I think we have a pretty fair idea of where your mind is at, and we'll circle back around and just summarize that here shortly. But let's just go through a quick little bit of game theory here, Brett, and try to. I don't want to map out because I don't want to pigeonhole us in any certain thinking, but I would be curious the next few days. The rest of today probably should be pretty quiet. I think the biggest thing that we could see would be a breaking of the session lows and a little bit of additional selling pressure coming in, but I wouldn't be taking too much away from that, as you just mentioned. But then we move into tomorrow and we get the Fed minutes. Now, looking at the comments from Powell following the last meeting, I don't necessarily get the idea that they will be as dovish as the market wants, because we were talking about the chance for policy missteps here, and I think the Fed's a little bit further ahead, or the market's a little bit further ahead than the Fed in terms of expectations for cuts. So let's just say, for argument's sake, these Fed minutes come in a little bit more hawkish than expected. What do you think the market would do in reaction?
I don't think that it will do anything in reaction.
Okay.
Because I think that we're just 2 days away from probably a more clear statement of where the Fed currently is. And since the last meeting, there's been a dramatic change. The last meeting was right at the highs, right?
Right.
We didn't have anywhere near the turmoil, not in market terms, not even in terms of economic data around the world. We didn't have the yuan devaluation.
Well, econ data
we didn't have all sorts of things.
Economic data was definitely on the decline in Germany and China. I had the PMIs.
Okay, but let's things have come to a more manifest head.
Okay.
Since then, it's particularly the yuan devaluation and the new tariff threats, and
sure.
all was after that meeting.
Yeah.
So
yeah,
I think that
it was the day after when they did the tariff threats, and then the yuan was that weekend.
Yeah, that's all shaping a new chapter, and this is going to be information about the last chapter. And I don't think that it has any relevance. Looking at what somebody happened to say before they knew about the new tariffs or the China's new tactic, which I think is a massively material item here. China came up with a new tactic, and it worked really, really well. And it has, I think, yes, absolutely. I think it has completely reshaped the game theory around the China negotiations. I think that it is now clear to the administration in the White House that China has a tool that they can use at any time that wipes out the impact of the tariffs on China, but keeps it in, to some extent in the United States, particularly because we've got people who want to export to China. And they can also target and not, look at for politically sensitive groups to Trump's campaign and target them, like the farmers, et cetera. And there's no upcoming campaign for Xi Jinping. So I think there's a situation now where China has, because of its command economy nature and because of the fact that they have been suspending their currency at too strong levels, right? It's not manipulation to weaken the yuan. It's stopping the manipulation to weaken the yuan. And they can do that at any time. And there's nobody who's really going to take seriously that China's a currency manipulator. Even if people think that that's what's happening, it's going to have no impact on how China experiences this negotiation. So I think that it is. I think that they tried it. It worked really well. And now that's a part of the equation. And I think that playing super hardball with China is not going to have nearly as much of an impact, particularly given that we're headed into the elections. So, I think that's a really enormous, that's something that can either cause the White House to really back off, or it can cause the White House to try even harder and to suffer more for it. So, I think it's changed the landscape. But that all happened after the last Fed meeting, and the minutes that we're about to see are representative of a world that didn't have that information. So I think what somebody's statements were from then really aren't going to present a lot of relevance to the market.
All right. So, well, then we go from there, and we move on to the PMI numbers. They'll start coming out Australia and Japan Wednesday night, Europe Thursday morning, and as well as the ECB minutes and the U.S. PMI numbers. Any thoughts there on any potential impact? I mean, I'm assuming that they're going to be pretty weak. Best, I think you could look for a bottoming pattern there. But do you think that has any impact on the market psyche ahead of Powell?
PMIs have been. I heard one analyst talking that it's essentially it's if you take the United States and India and there's one other country, but basically that's it, and everybody else is contracting.
I think the Netherlands probably.
It could something like that, but everybody else with any relevance in terms of the global economy, everybody else now is contracting in PMIs. So that's another point to just realize that's where we are, and that's typically, that's not usually a head fake situation. So especially when you've got a lot of leverage. So there's that, and I think that the market has maybe acclimated itself to somewhat to that, but maybe hasn't focused a whole lot on it, and that could crystallize a little bit more. At some point, I'm not sure how seriously people are taking that idea, but it seems to me like one that people should be taking seriously. So I think that if the United States started to show some PMI contraction, that might be the moment where people really start to say, whoa, now it's basically everybody in the world is seeing something that is a leading indicator flash, an extreme warning light.
All right, and then, of course, we got Powell. Early thoughts on what Powell's going to do?
So I think that he is backed into a corner completely in a no-win situation, and he will have to do what the market is telling him it predicts he will do. I don't think there's any way, after the experiences he's had recently, that he's going to come out there and give the market tough love. He could try to go for a very academic and intellectual statement where he doesn't comment in any way on the Fed's path of policy, but I think he already knows that people are expecting him to clarify his message from the last meeting. And his message from the last meeting was a failure.
Yeah.
In a lot of ways. He really did
one
not
of the poorest
handle
performances that I recall from a Fed chairperson.
And he's a bright guy. He's a good communicator. He just doesn't understand the rules of Fed communication, and that every single word is a specifically placed word with a specifically interpreted meaning, and the idea of what it seems to me to have been an agenda of his to come out with a more plain-spoken version of Fed speak, and that is a failed idea, and I think we see that now. Because people will parse it endlessly, and when you start to try to give the market more information and in a plain spoken way, it will backfire on you. And I think we've seen that a number of times. And I think now he wants to probably avoid being the CEO and start being the central banker. And there's successful models in the past for how to handle this kind of situation. Yellen was very good at it. Bernanke was very good at it. Greenspan was the master. Mario Draghi may be the master of ever, but look where that's gotten him at this point. But he's really good at that. He's really good at that dynamic. And I think that the idea here is what was up in the air last time is this a one-off insurance cut where the Fed's going to feel like no matter what, we've done something that's going to, in 12 months, have an impact on the economy that will act as a brake if things are declining, and we've done it. And that's that, and now we're moving on. And that was kind of a little bit of something you could interpret from what he did last time. And now I think the clarification and what the Fed funds futures market is very clearly pointing to is this is not a one-off insurance cut. This is an easing cycle, and there's going to be a cut in September, and there's going to be a cut in October, and there's going to be a cut in December, and maybe a cut in January, and there's going to be cuts and cuts and cuts. And that is what the market is starting to say. We need to hear you say that if things continue to feel like they do now, with PMIs flashing recession warning signals, the 2's 10s inverted, the 3-month 10s inverted, we're starting to see there's a rail number that's like it's declined 8 straight months now in terms of freight. There's a lot of things that show leading indications of problems to come, and you've got a lot of leverage in the system, particularly on the corporate side. And you've got everybody flying to sovereign debt all around the world, and at the same time you have an amplifying trade war. These are all things that suggest if you want inflation back to your target, then it is your responsibility as leader of the Fed to do whatever you can. Now, the question is, will he do that? And the other question is that the correct thing to do? But I think that he's backed into a corner. So I think that he's going to have to do that, or else he's going to be just roasted. So I think probably that's what the market would move up into this weekend on, is the idea that, or at least into Friday, the idea that he's going to basically be cornered into coming out and saying, we will be moving forward, something that equates to moving forward with further accommodation, something along those lines. So we already know the September cut's coming, that there may be room to the downside for policy rates or something along those lines. I think that that's going to have to happen, and that's what was missing last time around. I think he's cornered on that. I think that he would just get roasted for attempting to take a different tack.
Yeah.
What do you think?
Yeah, no, I mean, I'm basically, for my plan on preparing for it, I'm just going through everything that he said from his last press conference, got the transcript ready to go, and just looking for any changes there. Certainly going to comb through the minutes, but I think he could maybe get a little bit more dovish just to open the way for a possibility for some more rate cuts, especially since he knows that the Trump administration is going to probably continue to press the envelope here, just to press the Fed's hands, if anything. There's obviously no inflation out there for them to get overly excited about. So he's got no reason to move away. Like you said, they could try to reshape the conversation and use this as an academic forum that kind of leads to a different idea around either through
that's the most interesting thought, I think.
Yeah, like to really use this as a reset button on how the Fed's thinking in general. Using.
Here's a question for you, though. Let me ask you a question. So imagine in your mind the best thing for him to do, and I think this is oftentimes the case when the Fed is in a situation like this. I love the metaphor of high wire acrobats,
right?
As the economy and the business economy, people are doing tricks up there, whether they're on the the tightrope or whatever it is, way above the circus floor. Are they doing flips or what are they doing? What they're doing depends on whether or not there's a safety net underneath them that they have faith in. Right? There's a lot more risk taken when people believe that, well, there's some kind of protection if things start to go bad in the context that I'm in. And I think that if he were to find some way to say that we have tools, if things turn south from here, we can deal with it. And I'm not sure people believe that right now.
I don't think they do at all.
Well, that's what if you had a win for Jackson Hole, it would be that he would introduce something into the conversation that allowed people to go, oh wow, yeah, no, you're right. I guess if things go bad enough, they have this and it'll work. And that's not there.
Well, I can't even think of anything.
That's what my question was. Is there anything you can even imagine that he could introduce or could be introduced through panel discussions or whatever that suggests that there is this thing they've got, they've got this thing. And if things go bad, they can use this thing because this is great. And it's going to make everything okay. If things really start to turn bad, they'll just use the thing. And he doesn't have a thing. And, that's the nature of some of what Bernanke did. Years ago, we had this faith problem, and we saw things like Operation Twist come up in Jackson Hole, and there were different versions of different forms of asset buying that were new back then to the U.S. economy and to U.S. businesses to understand what the Fed could do because interest rates were gone as a tool, and it was, hey, do you have anything else you can do? And they kept on unveiling new strategies to reinvigorate things, and that worked for a bit. Like Operation Twist had a huge impact, even though it wasn't much at all. It was a new thing that the Fed could do, and people reacted to it. There was a new confidence that came from, the Fed's got this
Twist
thing.
wasn't necessarily something new. It was something old that they brought back, right? So is there anything old that they could bring back?
Yeah, right. Okay, fine. But to people now, it was new. It was like, whoa, we know about interest rate cuts and interest rate hikes. That's what we know about from the Fed. And the Fed is doing all this new stuff now. It's buying short-term bonds and buying long-term bonds, and buying different ratios and moving them about, and it's changing, incentivization and the game theory landscape, and it's causing different decisions, and that's going to stimulate the economy. And you're right. It was taken from something a long time ago. I suppose that, I don't know. Is there something that they can draw from the past and reintroduce? I don't know. I'm just wondering. That would be the ultimate win, I guess. I'm more approaching it from that side, that maybe they're sitting there having this conversation or have had this conversation. Is there some way to restore faith that there is a safety net, because that would allow people to take on more risk? And I think that that's one of the reasons you're seeing global bond yields go where they're going, because it's not just that things are deteriorating so rapidly in the EU. It's that things are deteriorating so rapidly in the EU and that nobody really believes that the ECB can do anything about it.
Right.
So then why take risk?
Yeah, and if the Fed starts falling into that,
if they look like they're in the liquidity trap.
QE's got to be the answer. I would think, maybe if he spends a lot of time talking
that's
about
old hat now.
It is old hat, but I'd have to go looking back at some of the other things that they've done, but it's not like they have that long of a history of intervention. I mean, it's only 112 years old or so, the institution, if that, right?
Yeah.
So outside of Operation Twist, the QE, obviously the rate cut leverages and stuff, but I don't know.
I think would be modern monetary theory until we start to get into that one.
I
coordinate with the Treasury in a much more obvious manner.
I suppose we could start seeing a lot more mention. I would think that the price targeting would probably be the winner. We know that that's something that Williams is completely on board with. So
just
perhaps
if
he starts mentioning that a little bit more.
Yeah, we're our target is no longer 2%, it's 3%, which means we're way under target now. We're going to need to stimulate like crazy to get back there, and I guess that could have an impact.
Yeah. So, but yeah, going to be an interesting couple of days, that's for sure.
Yeah, it will be.
So, all right, Brett. Well, we're running a little bit over an hour here, so I figure we'll probably wrap this up at this point. And you want to circle around on anything for a summary here?
Yeah, so, the basic idea is we've been in a situation where we've seen a lot of extremes and pessimistic sentiment over the last few weeks, as you know, and that is something that typically I would be bullish on. There's a relatively unique situation now where I believe that we may be only partway through a correction. I don't know how far it could conceivably go, but I believe that we are in a midpoint stage in that correction rather than that we have seen the final lows. I have a number of reasons for that. We talked about that earlier in the show. What I would suggest would be hints that that's a correct view would be to see a ratio of the amount of sentiment healing to the amount of market rally to be a poor one. In other words, you see a lot of sentiment healing on a relatively benign rally from here. You throw some shorts out by popping up through recent range highs, and we start to see a little bit of complacency come into things like the liquidity premium, the VIX term structure. We start to see headlines from this weekend that suggest that the Fed is going to be riding to the rescue. It's done what it needed to do in terms of basically saying this is not an insurance cut that we did last time. This is an easing cycle that we're going to continue to see. That leads to a little bit more complacency in the market, and then we see something that looks like a more important kind of offer, put a ceiling on the market. We start to see some negative technical behavior despite the sentiment healing that we've seen. And I think that that would set up a relatively interesting short side opportunity. I don't know whether any of that is necessarily going to play out, but it's what I'm looking for. But right now, more objectively, we have relatively neutral sentiment except for a couple of different measures. We've healed out of the extremes, but we are coming off an extreme. And if we start to see some genuinely good news, is this still a situation where we could see some pretty powerful buying if people started to move money back into the market? So if you're shorting, you need to be aware that you don't want to be scale shorting. You don't want to be shorting a bit here, it goes against you, shorting a bit more, it goes against you, shorting a bit more. That's a bad strategy for this kind of market, because if this thing does show some genuine strength, there's a ton of money on the sidelines locked up in bonds. There's probably a ton of shorts in this market. And if it starts to work, technically, if you don't see that lid, if you don't see that ceiling, then this is vulnerable to some pretty dramatic upside movements. So you need to watch out for that. But otherwise, we're not at extremes now. We're coming off of extremes. And it's going to be interesting to see what the next sequence is in terms of sentiment data in relationship to price action.
Yeah, it's something we'll obviously be waiting for. Hopefully we got enough events over the next few sessions that at least tip us into some direction. And again, it is going to be the backdrop with a little bit of holiday volume, so be curious to see how that plays into. So should be an interesting sentiment flow show next Tuesday, though, when we get a little bit more of these answers.
Yes, it will.
All right. Well, Brett, as always, thanks for joining us. I know there's a few feedback questions here for Brett. We'll circle back around to that and get you some answers on that. Either Brett will do it on the site or we'll bring him back in for a little bit. But for now, we're just going to close out this segment and bid everyone a farewell and talk to you in a couple minutes here.
Yeah, thanks, Gav. This was fun.
Yeah, definitely. Take care, Brett. Talk to you.